Welcome to Book Summary Podcast, your gateway to personal transformation. Each episode delivers big ideas from the world's most impactful books on mindset, productivity, and success, all in just a few minutes. Ready to turn knowledge into action? Let's get started.
You want to build wealth, you want financial freedom, and let's be honest, you probably want it now. We all do.
Absolutely. That pull is strong.
The allure of getting rich quickly, or, at least without too much fuss, is incredibly powerful.
Yeah.
But what if the secret to truly getting rich, and maybe more importantly, staying rich? What if it isn't just about making smart decisions or chasing the highest returns?
Right. What if it's something else?
What if it's about something far more subtle, more counterintuitive, something that comes with a hidden, non-monetary price tag we rarely acknowledge? Today, we're going to pull back the curtain on those invisible costs.
That's right. Today, we're taking a deep dive into Chapter 15 of Morgan Housel's The Psychology of Money, a really insightful piece titled, Nothing's Free.
Such a great title.
Isn't it? And this chapter, it doesn't just challenge our assumptions about financial gains. I think it fundamentally reshapes how we view the very act of building wealth. Our mission today is to, thoroughly unpack these often invisible prices, reveal their true nature, and show you precisely why understanding them, and frankly, embracing them, is absolutely crucial for your own financial journey.
Okay.
We'll explore why success so often looks, effortless from the outside, the dangerous psychological lure of trying to get something for nothing.
The big one.
Yeah, and perhaps most powerfully, how to make a critical mindset shift. Reframing market volatility, not as a fine for mistake, but as a necessary fee for participation.
Okay, let's unpack this core idea first, because it sounds simple, but it's profoundly overlooked in its implications. Many things in life, especially significant success, they appear deceptively easy to outsiders. Why? Because the internal struggles, the hidden costs, the relentless effort, and just the sheer emotional and mental toll involved are almost entirely invisible to anyone not, directly experiencing them.
Completely hidden.
We tend to see only the polished final outcome, completely missing the messy, demanding, and often painful process that led to it.
Yeah, we edit out the hard parts.
The source material gives us a compelling anecdote right at the start, one that really resonates. Think about General Electric, GE. For decades, a colossus of American industry, often the largest company in the world.
A giant.
Its CEO, Jeff Immelt, he navigated GE through the tumultuous aftermath of the 2008 financial crisis, which hit GE Capital, their huge financing division, particularly hard. Immelt faced immense public and investor criticism as the company struggled.
A lot of pressure.
But on his way out, he said something incredibly profound that really sticks with you, a statement born of deep experience. Every job looks easy when you're not the one doing it.
So true.
He was steering this enormous ship caught between conflicting demands of sprawling corporate bloat, the relentless pressure from short-term investors demanding quarterly gains, ever-changing global regulations, powerful labor unions, deeply entrenched bureaucracy.
Serrated layers of complexity.
Right, challenges that resisted change at every turn. These weren't just abstract challenges. They were daily, high-stakes decisions that carried enormous weight and were utterly invisible to the public or even, sharp market observers.
They just saw the stock price.
Exactly. They saw the stock price decline and were quick to cast blame. And what's more, his successor, who lasted only about 14 months, he very quickly learned the painful truth of Immelt's statement firsthand.
What's truly fascinating here, and I think critically important for our discussion, is how this invisibility of struggle applies universally. It's far beyond the corner office. From the outside, we inevitably only see the outcome, the success, the wealth, the seemingly effortless trajectory. We rarely get a glimpse into the conflicting pressures, the unpredictable, chaotic events, or just the sheer mental and emotional toll of making those high-stakes decisions, often under intense scrutiny and, frankly, with incomplete information.
Yeah, flying blind sometimes.
This human tendency to simplify complex narratives, to edit out the effort and the internal battle, it's a significant cognitive bias. It's why we so often misjudge the true cost of success in any field, whether it's a successful entrepreneur, an accomplished athlete, or yes, a financially savvy investor.
We see the gold medal,
But not the years of grueling training and sacrifice.
Yeah.
Exactly. We see the healthy portfolio, not the sleepless nights filled with doubt.
And this exact principle, this hidden non-monetary price tag, applies perhaps most powerfully in the arena of personal investing.
Oh, absolutely.
Everyone, and I mean everyone, offers that classic piece of advice: just buy and hold stocks for the long run. On the surface, it sounds so incredibly simple, right?
It's deceptively simple.
Like you just set up your investment account, forget about it for a few decades, and then poof, you magically wake up rich. But the source material makes it abundantly clear that sitting back and letting your money compound demands a very real, very insidious price.
It really does.
And that currency isn't just dollars and cents. It's a recurring mental and emotional tax, often levied precisely when you're least equipped to pay it, during market downturns or periods of intense uncertainty.
Exactly. The price of successful investing is almost never quantifiable on a simple balance sheet or, in a transaction fee.
Yeah.
It's paid in volatility, fear, doubt, uncertainty, and regret.
Wow. Those are heavy words.
They are. And these are not abstract concepts. These are visceral, emotional, and psychological costs that are incredibly easy to overlook when you're just reading about market history in a textbook. Where the charts show these smooth upward trending lines.
Yeah, the nice clean averages.
Right. You see the average annual return of, say, 8% or 10% per year, and it looks like a calm, steady climb. But you don't feel the gut-wrenching moments of panic, the deep second-guessing of your decision.
Oh, yeah.
The gnawing fear that you might be making a terrible, irreversible mistake that impacts your family's future until you're experiencing them in real time.
Right. It's the difference between knowing it might rain and actually getting caught in a downpour without an umbrella.
That's a great analogy.
Yeah.
It's the profound difference between intellectually knowing that the market goes up over time and actually living through a 20% or 30% drawdown when your entire retirement savings are on the line, wondering if this time is different.
And this is where it gets truly compelling, because the data really puts a fine point on those hidden emotional costs. Let's look at the Dow Jones Industrial Average.
Okay.
From 1950 to 2019, including dividends, it returned about 11% per year. That's a phenomenal long-term gain by any measure, something that could absolutely transform your financial future.
Fantastic return.
But here's the kicker: the price of success during that almost 70-year period. The market was at least 5% below its previous all-time high for nearly half the time, 49% of all trading days, to be precise.
Almost half the time.
Wow. Think about that for a moment. For a significant chunk of those 7 decades, if you were a rational, long-term investor, you would have been looking at your portfolio and seeing it down from its peak, maybe significantly down.
Right, not making new highs.
You had to endure that uncomfortable feeling of being down, to psychologically battle that perception of loss, just to get those magnificent long-term gains. It wasn't a smooth, uninterrupted climb by any stretch, despite what that simple average annual return might imply.
And if we dig into some of the most spectacular, truly wealth-creating investments, the necessity of paying this emotional price becomes even clearer and, frankly, more brutal.
Like what?
Take Netflix stock, for example. It returned over 35,000% from 2002 to 2018, an absolutely astronomical, life-changing return for those who held it.
Incredible.
Or Monster Beverage, which delivered a staggering 319,000% from 1995 to 2018.
Whoa.
These are the kinds of returns that create generational wealth, right? Stories of everyday millionaires.
Yeah.
But here's the often overlooked truth. For 94% to 95% of those days, their stock traded below its previous all-time high.
94 to 95% below the high water mark.
Let that sink in. This isn't just about finding the perfect entry point. It's about enduring the constant psychological battle of seeing your holdings drop from their peaks over and over again for years.
Ugh, that sounds exhausting.
To capture those incredible returns, you needed ironclad patience and an almost superhuman tolerance for sustained, gut-wrenching volatility. This wasn't a one-off dip you just rode out. It was the persistent, uncomfortable norm for these hyper-growth companies. The peaks felt like fleeting moments, while the valleys were your constant companion.
And that's the psychological trickery of relative value, isn't it? Our brains are wired to compare to the highest point we've seen, to that previous all-time high.
Exactly. That's the anchor.
So even if you're up significantly from your initial investment, seeing your portfolio down 10% or 20% from its peak can feel like a profound loss. It's that constant internal battle against the what if I had sold at the top.
Precisely. That constant comparison to the peak makes the inherent fee of volatility feel worse than it is. because your brain registers it as a loss from a perceived prior state of higher wealth. So what does this all mean for you, the listener?
Yeah, let's bring it home.
It means when you set financial goals, especially those involving investing in the stock market, you need to ask yourself a deeply personal question. What emotional and psychological prices are you truly willing to pay to achieve them?
Okay.
Are you prepared for the inevitable, sometimes extended periods of doubt, fear, and uncertainty that come with long-term investing? Are you ready to see your portfolio value drop not just once, but repeatedly, knowing that those periods of discomfort are the actual, unavoidable cost of admission to potential long-term wealth?
It's a serious gut check.
It really is. Because if you're not mentally and emotionally prepared to pay that fee, you're unlikely to stay in the game long enough for compounding to truly work its magic. You'll bail out at precisely the wrong moment, selling low and missing the subsequent recovery.
That's a crucial distinction. Because once we realize there's a price to pay, an emotional and psychological one, well, the natural human inclination is to try and bypass it.
Of course. Avoid the pain.
We want the reward without enduring the cost. In the world of finance, the source material brilliantly describes this as trying to achieve the equivalent of Grand Theft Auto.
Ah, that's a good one.
Attempting to capture market returns while somehow, magically, avoiding the inherent volatility that comes along with them. It's an incredibly attractive, albeit ultimately disastrous fantasy.
Very seductive.
Think about a simple everyday analogy. Imagine you want a brand new luxury car that costs, say, $80,000.
Yeah.
You essentially have three main options. You can pay the $80,000 for it.
Option 1.
You can find a cheaper used one.
Option 2, more reasonable perhaps.
Or you can try to steal it. Option 3. Most of us instinctively know option 3 is utterly disastrous. The consequences of stealing a car, the legal stuff, the social shame, the long-term financial fallout, they far outweigh any immediate fleeting upside of getting the car for free.
Absolutely clear consequences.
But in investing, the stealing isn't as obvious. The immediate consequences aren't as clear or as legally defined. And the temptation to get something for nothing can be overwhelming precisely because it feels like a subtle workaround, not, a blatant crime.
It feels like you're just being clever.
Right. We often don't even realize we're attempting it until it's far too late and the bill comes due.
That's precisely the problem. The price of investing success isn't displayed on a clear upfront sticker like that car's price tag. So when the bill for market returns comes due, not in dollars, but in the form of volatility, fear, and doubt, those emotional costs we just discussed, it doesn't feel like a necessary fee for getting something incredibly valuable.
No, it feels awful.
Instead, it feels like a fine for doing something wrong, a punishment for a mistake. And culturally, psychologically, we are conditioned to avoid fines at all costs.
Yeah, you get a parking ticket, you're annoyed, you try to fight it maybe.
Exactly. Fines are associated with penalties, with something we should have prevented or something we need to appeal. This fundamental misunderstanding, viewing an unavoidable cost as an avoidable penalty, drives a tremendous amount of detrimental behavior in the market. It pushes people to try and outsmart the system when often the system just is.
Okay, so let's look at some specific real-world case studies that vividly illustrate this dangerous temptation to try and avoid paying the price. The source material talks about tactical mutual funds.
I asked the market timers.
These funds are explicitly designed with the strategy of trying to capture market returns with lower downside risk by actively switching between stocks and bonds at what they perceive as opportune times. Their promise is compelling. They want to give you the gains without the pain, essentially.
The Holy Grail, right?
Exactly. So Morningstar, a highly respected investment research firm, conducted a significant study on 112 such funds from mid-2010 to late 2011. Now, this was a particularly volatile period, marked by fears of a new recession and a more than 20% decline in the S&P 500.
Perfect testing ground.
Precisely the kind of environment when these tactical funds, with their promise of downside protection, should have shined brightest. So when these funds were put to the test, what did Morningstar find?
Well, what Morningstar uncovered was quite telling and pretty sobering for anyone seeking to bypass volatility. Of those 112 tactical funds, only 9, a tiny fraction,
That's not.
just 9, actually had better risk-adjusted returns than a simple hands-off 60/40 stock bond fund. Now, for our listeners, risk-adjusted returns essentially means how much return you generate for each unit of risk you take. Higher is better.
So very few actually delivered on that core promise.
Very few. And the findings didn't stop there. Less than a quarter of these tactical funds even had smaller maximum drawdowns than that basic index fund. A maximum drawdown is the largest peak-to-trough decline in value your portfolio experiences over a period.
So they didn't even protect the downside better, most of them.
For the most part, no. Morningstar concluded that, and I quote, "With a few exceptions, tactical funds gained less, were more volatile, or were subject to just as much downside risk as the simple passive 60/40 fund."
Wow.
This highlights a profound irony. By actively trying to avoid the natural inherent price of market volatility, these investors and funds often ended up gaining less while paradoxically experiencing similar or even greater levels of volatility.
So trying to dodge the fee.
In essence, by trying to avoid the admission fee, they frequently ended up paying double without even getting the desired reward of market-beating returns. It just didn't work out.
And this isn't just a phenomenon limited to professional fund managers or complex products, right? Individual investor behavior often falls into this exact same trap, but on a personal scale.
Oh, absolutely. All the time.
Morningstar also consistently found that the average equity fund investor historically underperformed the very funds they were invested in by about 0.5% per year. Why?
Well, it comes down to behavior.
It's because of buying and selling at precisely the wrong times. They would attempt to dodge downturns, selling when the market got scary, but then inevitably missing the subsequent rebounds that almost always follow those corrections.
Classic panic selling and FOMO buying.
This reactive behavior, driven by the intense desire to avoid the fine of a falling market, locks in losses and prevents participation in the recovery, severely eroding long-term returns. It's a classic, painful example of trying to time the market and failing all because that emotional price felt too high to pay in the moment.
It's emotionally rational, maybe, in the short term.
Yeah, feels right.
At the time, but financially catastrophic long term. This tendency to try and smooth out the bumps, to, engineer predictability where none naturally exists isn't new. And it's not limited to individual investors or even fund managers. We've seen it play out at the highest levels of corporate finance with, frankly, devastating consequences.
You mentioned GE earlier.
Right, consider General Electric again. But this time under its former legendary CEO, Jack Welch. He became almost mythical for ensuring GE's quarterly earnings always beat Wall Street estimates.
The consistency king.
He created this illusion of perfect predictability. And how did he achieve this? By massaging the numbers. And that's being charitable, meaning they engaged in accounting maneuvers, often by prematurely recognizing revenue or delaying expenses.
Kicking the can down the road.
Essentially borrowing from future performance to make the current quarter look artificially stable and strong. It was like paying today's bills with tomorrow's earnings, a strategy designed to avoid any unexpected fines in the form of missed earnings estimates.
And the market loved it for a while.
Stockholders loved it for a time. They got consistency and predictability, a seemingly smooth ride without the price of uncertainty or unexpected dips. But the bill always comes due. Years later, after Welch's departure, GE shareholders suffered a decade of mammoth losses. The penny gains of Welch's era turning into dime losses, as the true deferred costs of that artificial smoothness were finally recognized and paid. It created an illusion of strength that just couldn't be sustained.
Wow, so that drive for smoothness cost them dearly later on.
Hugely. And even failed mortgage giants, Freddie Mac and Fannie Mae, engaged in a similar kind of financial illusion back in the early 2000s. They were caught underreporting current earnings by billions of dollars.
Billions?
Billions, with the explicit intention of spreading those gains out over future periods. Again, the goal was to create this perception of smoothness and predictability for investors, avoiding the current visible price of market fluctuations in business cycles.
Just trying to make everything look steady.
They wanted to present a calm, steady picture to the market, even if it meant distorting reality and pushing liabilities into the future.
It's astonishing how pervasive this desire is, isn't it? Across all levels of finance, from the individual investor panicking during a dip, to the fund manager trying to time the market, to the C-suite executive trying to smooth out earnings.
It really is.
The thread running through all these examples is the attempt to circumvent the natural, inevitable price of achieving something valuable.
Absolutely. This behavior, whether by individuals, funds, or executives, stems from a fundamental misunderstanding. Thinking of market volatility or any inherent business uncertainty as a penalty, a fine, for doing something wrong.
Instead of just the cost of doing business.
Rather than a necessary inherent part of the process of generating wealth or running a successful enterprise. If you believe it's a fine, your natural, deeply human response is to try and avoid it, to sidestep it, to outsmart it. And in finance, this almost always leads to decisions that ultimately hurt your long-term financial health and prevent you from receiving the very returns you're seeking in the first place.
It's an emotional reaction.
To a perceived threat, rather than a rational acceptance of a transactional cost.
Yeah.
Yeah. So to succeed financially, especially in long-term investing, you have to learn to make this crucial and, let's be honest, often difficult mindset shift.
Okay, what is it?
You have to view market volatility as an admission fee, a cost worth paying for the experience of earning market returns rather than a fine for making a mistake or doing something wrong.
Admission fee versus a fine. I like that.
It's about accepting that there's a necessary, upfront, and ongoing cost for a valuable service or outcome, much like paying for entry to an event rather than being punished for an error. This reframing is not just semantics, it's really the core of a resilient investment philosophy.
It's easy to say, though, just reframe your thinking, right? But how many of us can genuinely deep down say, I'm actually fine if I lose 20% of my money this year?
It's tough, really tough.
Or I am perfectly comfortable with my portfolio being below its all-time high for years on end, especially for new investors who've never lived through a significant market decline. That kind of loss can feel absolutely devastating.
Yeah, terrifying.
Not like a fee at all, but like a deeply personal penalty, maybe a betrayal of trust in the system, or worse, confirmation of your own foolishness for even trying.
And if you're close to a goal.
Right. For anyone who's tying their investments to a specific near-term goal like retirement in 5 years or a kid's college tuition next semester, the emotional weight of seeing your wealth diminish, even temporarily, can be incredibly difficult to bear regardless of how rational, the long-term prospects might be. It's a very real psychological hurdle.
Absolutely. The theory is one thing, living it is another.
The source material gives a brilliant analogy, though, that really helps to clarify this mindset shift, and it's one that almost everyone can relate to. Disneyland.
The happiest place on earth.
Yeah.
With a price tag.
Exactly. Imagine Disneyland tickets cost, say, $100. People pay it, often without a second thought, for what they anticipate will be an awesome day with your kids you'll never forget.
They know the cost going in.
Few, if any, see that $100 as a punishment or a fine. It's universally understood as a worthwhile trade-off, a necessary expense, an admission fee for a desired experience.
Mm-hmm.
You understand what you're getting for that money, the rides, the shows, the overpriced food, maybe?
Definitely the overpriced food.
The memories, the joy. It's an accepted, pre-calculated part of the deal.
Applying this directly to investing, the parallel becomes incredibly clear. Market returns are never truly free. They demand a price.
The volatility.
The volatility, the uncertainty, the fear, the doubt, the regret. That's the cost of admission. You're not forced to pay it, just like you're not forced to go to Disneyland.
You have choices.
You can absolutely choose to stay home or choose to go to a, let's say, county fair with lower cost tickets, like holding your money in cash or investing exclusively in bonds. These offer lower returns, but also significantly less volatility.
Lower fee, maybe less thrill.
But typically, as in life, you get what you pay for. The higher potential returns of the stock market, the magic of long-term compounding, comes with that inherent, unavoidable cost of emotional discomfort and unpredictable fluctuations. It's not optional. It's part of the package.
So the real trick then is convincing yourself truly, deeply, that the market's fee is worth it.
That's the crux of it.
It's not just about putting up with volatility and, gritting your teeth through the tough times, saying, well, I have to endure this. It's about actively internalizing down to your core that it's an admission fee genuinely worth paying for the potentially much greater long-term returns and the unique financial freedom that stocks can provide.
It's a conscious acceptance.
It's an act of conscious, deliberate acceptance, a recognition that this is simply how the system works to deliver its rewards. You're buying into the growth and innovation of the world's greatest companies, and volatility is simply the transaction cost, the necessary friction of that system. How do you, as an expert, help people truly internalize that, beyond just, nodding along intellectually?
That's a profound question. Because you're right, the intellectual understanding is often the easy part. The emotional acceptance is the true challenge. I often tell people to explicitly budget for this emotional cost.
Budget for emotions? How does that work?
Just as you budget for your rent or your groceries, you need to budget, mentally at least, for the inevitable periods of fear and doubt in your investment journey. Don't just plan for the upside, plan for the downside emotionally.
Okay.
What will you do when your portfolio is down 25%? Will you panic? Or will you view it as a necessary part of the journey to the higher returns you desire, much like maybe a business owner views operating expenses? It's about pre-committing to the fee.
Deciding ahead of time.
Yes. If you've consciously decided it's worth it before the market drops, you're far less likely to act impulsively during the drop. You've already accepted the terms.
That makes sense. You've already paid the fee mentally.
Exactly. Of course, there's no guarantee every Disneyland trip will be perfect. Sometimes it rains, sometimes the lines are too long, sometimes a ride is closed.
Right, things go wrong.
Similarly, in the market, there's no guarantee that every investment will be a winner, or that a period of volatility will always be followed by a swift rebound exactly when you expect it. There are always risks. But the key insight and the profound power of this reframing is this. If you view the admission fee as a fine,
Something to avoid.
something to be avoided or circumvented at all costs, you'll never truly enjoy the magic, or in this case, reap the potential rewards. You'll be constantly trying to avoid it, reacting emotionally, making poor, short-sighted decisions, and likely miss out on the immense long-term gains that the market has historically provided for those with the patience to accept its terms.
So accepting the fee is key to staying invested.
It allows you to stay invested long enough for the powerful forces of innovation and compounding to eventually, hopefully, fall in your favor.
So for your own financial journey, this chapter really urges you to ask a fundamental question and then act upon it. Find the price, then pay it.
Simple but powerful.
Identify the non-monetary costs, the volatility, the doubt, the uncertainty, the regret, the sheer mental discomfort that inherently come with your chosen financial goals, especially investing in growth assets like stocks. Then, consciously and deliberately decide that those costs are worth paying for the potential much greater long-term rewards.
That's the mindset shift.
That's the mindset shift that truly sets you up for enduring financial success and allows you to approach your wealth-building journey with resilience, clarity, and maybe a remarkable sense of calm, rather than constant anxiety and reactive fear. It turns a penalty into just a planned expense. Hashtag tag outro.
So today we've taken a deep dive into this profound idea that nothing in finance is truly free. Every significant financial gain, every truly worthwhile reward, it comes with a price. This price isn't always paid in dollars and cents, but in the less tangible yet equally real costs of volatility, fear, doubt, uncertainty, and regret.
The invisible stuff.
Exactly. By understanding and, more importantly, accepting these as necessary fees, the cost of admission to higher potential returns, rather than punitive fines for making mistakes, you unlock a far more robust and resilient approach to wealth building. This reframing is essential for maintaining a long-term perspective and for avoiding those dangerous, wealth-eroding traps of trying to get something for nothing.
As you reflect on your own financial aspirations, maybe ask yourself, are you actively trying to get something for nothing? Are you resisting the inevitable emotional costs that come with pursuing those goals?
It's a good question to sit with.
Our deep dive today makes a powerful case that true financial mastery isn't about expertly avoiding these costs, which is often impossible anyway, but about consciously deciding they're worth paying. What admission fee are you truly willing to pay for your ultimate financial freedom? And maybe more pointedly, are your current actions truly aligning with that commitment?
Yeah, are you walking the talk? It's a question worth pondering deeply as you navigate your own unique financial path.
Definitely food for thought.
And next time on The Deep Dive, we'll continue this fascinating journey through Morgan Housel's The Psychology of Money as we delve into Chapter 16, titled You and Me.
Ooh, intriguing.
It is. We'll explore why comparing your financial journey to others can be such a dangerous game, and how to identify the financial game you're truly playing, rather than inadvertently falling prey to someone else's rulebook and someone else's goals.
Sounds essential. Well, thank you for joining us on this deep dive. Until next time, stay curious, stay informed, and keep making those reasonable, resilient financial decisions.
Thanks for tuning in to the Book Summary Podcast. If you found value in today's episode, hit that like button, subscribe for more summaries, and share it with someone who's ready to grow. Want deeper insights, exclusive book notes, and reading tips? Join our free newsletter. The link's in the description. And don't forget, if you'd like to read the full book, our affiliate link is right below. It helps support the channel and keeps the summaries coming. Until next time, keep reading, keep growing.